Hello dear students, in this video I will continue with revision on financial mathematics. In this video I will discuss the topics EMI, compound annual growth rate, returns, nominal and effective rate and depreciation. First we will see what is EMI. EMI it stands for equated monthly installment. So this EMI it is a monthly payment which a person has to make towards a loan that the person has opted for at a fixed date of every month. So we say a loan is amortized if it can be discharged by a sequence of equal payments, namely EMI, and these payments are made over equal periods of time. Now this each payment it can be considered as consisting of two parts. So the EMI is the sum of two parts, which is interest on the outstanding loan and repayment of part of the loan. So we say a loan is amortized if the interest on the outstanding loan and the repayment of part of the loan, it can be done using this EMI over a period of time where EMI is made over equal periods of time. Next we have methods of calculations of EMI. The first one is flat rate method. Here each interest charge is calculated based on the original loan amount. Here even though the loan balance is gradually being paid down, the interest is calculated based on the original loan amount. If we consider P as the principal of the loan, I as the total interest on the principal, and N as the number of months in the loan period, then EMI is given by the formula using flat rate method as EMI is equal to P plus I upon N. So this is how EMI is calculated using flat rate method. And now we have calculation of EMI using the next method, which is reducing balance method, or these formulas are called amortization formulas. The first one is the periodic payment or installment, that is the EMI which is equal to R. It is given by P upon A at an angle N for I rate per period. Now this A at an angle N for I rate per period, it is nothing but it is the present value annuity factor. So this is equal to 1 minus 1 plus I the whole raised to minus N upon I. So this when we substitute here, we get R is equal to P into I upon 1 minus 1 plus I the whole raised to minus N. Here P is the amount of loan, then I is the rate per period, and N is the number of equal payments or the number of installments. And next we have the principal outstanding at the beginning of kth period. So the principal outstanding at the beginning of kth period, it is given by R into A at an angle N minus K plus 1 for I rate per period. So A at an angle N for I rate per period is 1 minus 1 plus I the whole raised to minus N by I. This is equal to R into 1 minus 1 plus I the whole raised to minus N plus K minus 1 upon I. So if you want to find the principal outstanding at the beginning of kth period, this formula can be used. Next we have the total interest paid. Here P is the amount of loan and N is the number of equal installments and R is the size of each EMI. So the total interest paid will be N into the EMI, that is the number of equal payments into size of each payment minus the loan amount, that is the principal amount, because EMI consists of two parts, which is interest and some part of principal. So the total interest paid can be calculated as N into R minus P. Question on EMI was asked for 4 marks in the sample paper. Now we'll see a practice question. Mr. Kundan wants to purchase a car for rupees 25 lakhs with down payment of rupees 10 lakhs. If he can amortize the balance at 8% per annum, compounded monthly for 7 years, what is the monthly payment? What is the total interest paid? Similar question was asked for 4 marks. So here Mr. Kundan, he wants to purchase a car for 25 lakhs. Maybe he is a very rich person. So he is making a down payment of rupees 10 lakh. It means the amount for which he gets a loan is 25 lakhs minus 10 lakhs, which is 15 lakhs. And here the interest rate is given as 8% per annum. And the number of years is 7 years. We have to find the monthly payment and the total interest paid. Now first let us find the amortized amount. Amortized amount is nothing but it is the cost of the car minus cash down payment given by P. So the cost of the car is rupees 25 lakhs and the cash down payment is rupees 10 lakhs. So this is rupees 15 lakhs. This is the first subdivision. And next let us find the rate per period. Here it is given 8% per annum is compounded monthly. So I will be 8% upon 12. It is 0.08 by 12, which is 0.0066. And next we have the time period. The number of installments. The number of installments is given by 7 into 12. Each year there are 12 installments. In 7 years there are 7 into 12 installments, which is 84. We have EMI is equal to R is equal to P upon A at an angle I for I rate per period. It is P into I upon 1 minus 1 plus I the whole raised to minus N. Now if we substitute each of the values from here, we will be able to find EMI. This is P. So this implies R is equal to P is 15 lakhs, I is 0.0066 upon 1 minus 1 plus 0.0066 the whole raised to minus N. N is 84. So this is equal to, here 15 lakhs into 0.0066, it is 9,900 upon 1 minus this 1.0066 the whole raised to minus 84, it is given as 0.5755. 0.5755. So this is equal to 9,800 upon 0.4245. This when we simplify, we get EMI as 23,321.55. Therefore, EMI is equal to rupees 23,321.55. So this is the monthly payment. And next we have total interest paid. The total interest paid, it is calculated as N into R minus P. This is R and N is 84. So it is 84 into 23,321.55 minus principal is 15 lakhs. 15 lakhs. This is 19 lakh 59,000 and 10.20 minus 15 lakhs, or it is equal to 4 lakh 59,000 and 10.20 rupees. So this is the total interest paid. Here writing what is given, finding the amortized amount carries 1 mark. Writing the formula alone carries 1 mark. Then substituting the values and finding the EMI or the monthly payment carries 1 mark. And finding the total interest paid. All these steps carries 1 mark. So a total of 4 marks. Moving on to the next question. A person buys a house for which he agrees to pay rupees 25,000 at the end of each month for 8 years. If money is worth 12% compounded converted monthly, what is the cash price of the house. So in the previous question, the price of the car and the down payment made was given, and we need to find EMI. Here EMI is given. We need to find the cash price of the house. So let P be the cash price of the house. Given EMI equal to R is equal to rupees 25,000. Then I is 12%, which is compounded monthly, so it is 12% by 12, so it is 0.12 by 12, or it is equal to 0.01. And N is, it is repaid in 8 years, so N is 8 into 12, which is 96. We have P is equal to R into A at an angle N for I rate per period, or it is R into 1 minus 1 plus I the whole raised to minus N upon I. We have all the values given. When we substitute this, we will be able to find P. So P is equal to R is 25,000 into 1 minus 1 plus I is 0.01 the whole raised to minus N is 96 upon 0.01. So this is equal to 25,000 upon 0.01. It is 25 lakhs into 1 minus 1.01 the whole raised to minus 96. It is 25 lakhs into 1 minus 1.01 the whole raised to minus 96 is given as 0.3847. 0.3847. So it is 25 lakhs into 0.6153. Now this when we multiply, we get it as 15,38,250. Therefore, cash price of house equal to rupees 15,38,250. So this is the cash price of the house. Moving on to the next question. It's given Kirti borrowed money and returned it in 3 equal quarterly installments of rupees 4,630.5 each. What sum had she borrowed if the rate of interest was 20% per annum compounded quarterly? Also find the interest charged. So here it is given she has borrowed money and returned it in 3 equal quarterly installments of this much amount, 4,630.5. We need to find the sum she had borrowed if the rate of interest was 20% per annum compounded quarterly. And we should also find the total interest charged. Here let P be the sum borrowed. So given the equal quarterly installment R is rupees 4,630.5 and I is rate of interest is 20% per annum compounded quarterly. So I is 20% upon 4, or it is 0.2 by 4, which is 0.05. And then N is the number of installments is 3. So N is equal to 3. Now we have the formula P is equal to R into A at an angle N for I rate per period. So it is R into 1 minus 1 plus I the whole raised to minus N upon I. We have all the values here R, I and N. If we substitute, we will get the value for sum borrowed P. So this is equal to R is 4,630.5 into 1 minus 1 plus I is 0.05 the whole raised to minus N is 3 upon 0.05. So we have P is equal to 4630.5 upon 0.05, 92,610 into 1 minus, here we have 1.05 the whole raised to minus 3. That we can write it as 1 by 1.05 the whole cube. So this is 92,610 into 1 minus 1 by 1.1576. So this, when we simplify, we get it as 92,610 into 1 minus 0.8638. 92,610 into 1 minus 0.8638 is 0.1362. So this, when we simplify, 0.8638. This, when we simplify, we get it as rupees 12,613.5. Therefore, sum borrowed equal to rupees 12,613.5. Next, we have to find the total interest charged. So it is calculated as n into r minus p. This is p. Here n is 3, r is 4,630.5 minus p is 12,613.5. So this is 13,891.5 minus 12,613.5. The value of this is equal to 1,278. Therefore, total interest charged equal to rupees 1,278. Now moving on to the next question. It is an example question from the textbook. Mr. X takes a loan of rupees 2 lakhs with 10% annual interest rate for 5 years. Calculate EMI under flat rate system. So this is an example for flat rate system. So here the loan amount is given, annual interest rate is given, and the time period is given. We need to find EMI. EMI is equated monthly installments. That too under flat rate system, that we have to find. So it is given P is rupees 2 lakhs. Next we have to find the total interest I. Interest for 1 year is 10% of 2 lakhs. Interest for 5 years will be 5 into 10% of 2 lakhs. So total interest capital I is equal to 5 into 10% of 2 lakhs. So it is rupees 1 lakh. N is given as 5 years. It is not repaid every year. It is repaid as equated monthly installment. So N will be 5 into 12, which is 60. Under flat rate system, EMI is equal to P plus I upon N. So we get EMI as 2 lakhs plus 1 lakh upon 60. N is 60. So it is 3 lakhs upon 60, which is rupees 5,000. So EMI is equal to rupees 5,000. So this is an example for calculating EMI using flat rate system. Moving on to the next question. Find the present value of annuity of rupees 1,900 payable at the end of each year for 3 years if money is worth 5% compounded annually. Given 1.056 the whole raised to minus 3 equal to 0.84 92. So this is finding the present value of ordinary annuity. If we see EMI, the loan amount P, it is nothing but it is the present value of annuity of R. So this is present value of annuity of R. So like that we can use the same formula to find the present value of ordinary annuity. Here first let us write what is given. We need to find the present value of annuity of rupees 1900. So R is rupees 1900. Here it is payable at the end of each year for 3 years. So N is 3. If money is worth 5.6% compounded annually, I is 5.6% or it is 0.056. Here it is compounded annually and we need to find this present value at the end of each year. So N is 3 and I is 0.056. The present value of ordinary annuity P, it is equal to R into 1 minus 1 plus I the whole raised to minus N upon I. Since it is compounded annually, we can take this as either I or R. So it is 1900 into 1 minus 1 plus 0.056 the whole raised to minus 3 upon 0.056. So P is equal to 1900 upon 0.056 is 33,928.59 into 1 minus 1.056 the whole raised to minus 3. So it is the value of 1.056 the whole raised to minus 3 is given here into 1 minus 0.8492. So it is 33,928.59 into 0.1508. This when we simplify, we get it as rupees 5,116.43. So this is the present value of annuity of rupees 1900 payable at the end of each year for 3 years when money is compounded 5.6% annually. Similar question was asked for 2 marks. Here writing the formula for present value of ordinary annuity, it carries 1 mark. Substituting the values and the final answer carries 1 mark. So total of 2 marks. Now moving on to the next topic, which is rate of return. Now rate of return or return on investment, we are familiar with this formula. It is given by net profit or loss minus cost of investment upon cost of investment. Or it can also be calculated as the current value of investment minus cost of investment upon cost of investment. This is nothing but it is the ending value minus starting value upon starting value of investment. There is another formula for finding this rate of return in case of operations. It is given by total returns minus total expenses upon cost of investment. And next we have nominal and effective rate of interest. Nominal rate of interest, it is the announced or the stated rate of interest. Effective rate of interest, it is the actual rate by which money grows during each year. That is effective rate of interest. Now we will see the relationship between effective rate of interest and nominal rate of interest. If R is the nominal rate of interest compounded m times in a year, the effective rate of interest R effective is given by R effective equal to 1 plus R by m the whole raised to m minus 1. Now this is the effective rate of interest when the nominal rate of interest R is compounded m times in a year. If the nominal rate of interest is compounded continuously, then R effective is given by e raised to R minus 1. So these are the formulae that we have to study in rate of return and nominal and effective rate of interest. And now we will start with Practice questions. Similar question was asked in the sample paper for 2 marks. Find the effective rate which is equivalent to a stated rate of 5% compounded semi-annually. So we have to find the effective rate which is equivalent to the nominal rate of 5% and it is compounded semi-annually. So here the nominal rate is given, R is 5% and M is 2. It is the number of conversion periods in a year. Since it is compounded semi-annually, so we have every 6 months it is compounded, M is 2 times in a year. We have R effective equal to 1 plus R by M the whole raised to M minus 1. So it is 1 plus 0.05 by 2 the whole square minus 1. So it is 1 plus 0.025 the whole square minus 1. 1.025 the whole square minus 1. It is 1.0506 minus 1. Or it is 0.0506. Therefore, R effective is equal to 5.06%. Here writing the formula carries 1 mark and substituting the values, remaining steps and the final answer carries 1 mark. Moving on to the next question. Find the force of interest corresponding to the effective rate 11%. So here the effective rate is given. We need to find the nominal rate of interest. So let us take, let R be the nominal rate of interest. Given effective rate of interest equal to 11% or it is 0.11. So we have the formula. We have to find the force of interest. So it means the interest is compounded continuously. So we have R effective equal to e raised to R minus 1. So from this we get 0.11 equal to e raised to R minus 1 or e raised to R is equal to 1 plus 0.11. It is 1.11. If we take log on both sides, we get R log E equal to log 1.11. Now this is to the base 10. So we cannot write log E as 1. If you are taking it to the base E, then it is okay. Here it is to the base 10. The value of E is 2.718. So the common logarithm values for 1.11 and E it is given. When we substitute these values, we will find R. So R is equal to log 1.11 upon log E. Log 1.11 is 0.0453 upon log E is 0.4342. Now this when we simplify, we get it as 0.1043. Therefore, R is equal to 10.43%. So, a force of interest of 10.43% corresponds to an effective rate of 11%. Moving on to the next question. It is an example question from the CBSE Handbook. Mr. X took a loan of rupees 2000 for 6 months. Lender deducts rupees 200 as interest while lending. Find the effective rate of interest charged by the lender. So here X took a loan of rupees 2000 for 6 months and in this 2000 rupees itself lender deducts 200 as interest. So the amount which Mr. X gets is only 1800 and the time period is 6 months. We need to find the effective rate of interest. So the interest amount, it is given as rupees 200. The loan amount will be 2000 minus 200. It is rupees 1800. So the interest rate for 6 months will be 200 upon 1800. It is the rate per period I. This is nothing but this is R by M and it is equal to 200 upon 1800 which is 1 by 9. And then Mr. X has taken a loan for 6 months. It means the number of conversion periods in 1 year will be 2. So we have R effective is equal to 1 plus R by M the whole raised to M minus 1. So it is 1 plus this 1 by 9. It is 0.11. 1 plus 0.11 the whole square minus 1. Or it is 1.11 the whole square minus 1. It is 1.2345 minus 1, which is 0.2345. So the effective rate of interest is 23.45%. So it is a very huge interest. For 6 months, deducting 200 for a loan of rupees 2000, the effective interest rate is 23.45%. Next we have, to what sum will rupees 16,000 accumulate in 8 years if invested at an effective rate of 8%? Given 1.08 the whole raised to 8 is 1.85. Now this is nothing but this is the future value of this amount. We have to find the future value of rupees 16,000 after 8 years if the effective rate is 8%. So let us take, let the sum accumulated be A. So we are given P is equal to rupees 16,000, N is equal to 8 and R is equal to 8%, which is 0.08. So it is the usual formula which we have studied. We have A is equal to P into 1 plus R the whole raised to N. So here P is 16,000 into 1 plus R is 0.08 the whole raised to N is 8. So it is 16,000 into 1.08 the whole raised to 8 is given as 1.85 into 1.85. This when we simplify we get it as 29,600. So the sum accumulated is rupees 29,600. Therefore, A is equal to rupees 29,600. This is also an example question. It is the next type of question where we have to compare two investment options. Mr. Y has two investment options, either at 10% per annum compounded semi-annually or 9% per annum compounded continuously. Which option is preferable and why? So we have to compare these two options. That is, in both these options, we have to find the effective rate and we have to say the one whose effective rate is more is, it is more preferable. First, let us take when 10% is compounded semi-annually. We have R as 0.1 and M as 2. R effective is equal to 1 plus R by M the whole raised to M minus 1. So it is 1 plus 0.1 by 2 the whole square minus 1. It is 1 plus 0.05 the whole square minus 1, or it is 1.05 square minus 1. 1.05 square is 1.1025. So this when we simplify, we get 0.1025. So for this investment option, we get the effective rate of interest as 10.25%. When 9.5% is compounded continuously, we have R as 0.095. In this case, R effective will be e raised to R minus 1, or it is e raised to 0.095 minus 1. The question itself, the value of e raised to 0.095 is given. So it is 1.0997 minus 1, which is 0.0997. In this case, the effective rate of interest is 9.97%. So when 10% is compounded semi-annually, the effective rate of interest is more. So this is a better option. Since R effective is more for 10% compounded semi-annually, it is a better option. So this is the next type of question. So the first type is nominal rate is given, we have to find the effective rate. Then the second type which we saw was effective rate was given, then we have to find nominal rate, and then finding the interest, and then finding the effective rate. And this is another question where we have to compare two options. Next we have another type of question where we have to find the rate of return. Anna owns a produced truck, invested rupees 700 in purchasing the truck. Some other initial admin related and insurance expenses of rupees 1500 to get the business going, and has now a day-to-day expense of rupees 500 per month. Consider hypothetically that her everyday profit is rupees 550 per month, which is based on sales. At the end of 6 months, Anna takes up her accounts and calculates her rate of return. Find the rate of return. So this is a hypothetical question. So the cost of investment is 700 plus the other expenses 1500, and then the day-to-day expenses it is given by 500 per month, and the profit or the returns is given by 550 per month. We need to find the rate of return at the end of 6 months. So here the cost of investment is 700 plus 1500. It is rupees 2200. And then expenses per month it is given as rupees 500. So at the end of 6 months, the expenses will be 500 into 6, which is rupees 3000. Then the profit per month is given as rupees 550. At the end of 6 months, profit will be 550 into 6. So it is 3300. And now we have seen a formula, rate of return is equal to total returns minus total expenses upon cost of investment. So using this formula, the total returns is 3300 minus total expenses is 3000 upon cost of investment is 2200. So it is 300 upon 2200, which is 0.1363. So the rate of return is 13.63%. So this is the rate of return at the end of 6 months. Now we have the next topic, compound annual growth rate. It depicts the cumulative performance of a particular variable over a period of time via compounding effect. So the cumulative performance of a particular variable. The variable can be investments, or it can be profit, or it can be sales, it can be anything. So it basically depicts the cumulative performance of that variable using compounding effect over a period of time. It is used to evaluate the performance of different investments by an individual or an enterprise through the annual rate of return. Now this annual rate of return is calculated as investments ending value minus starting value upon investment starting value. And next we have the formula for this compound annual growth rate. If EV is the investment's ending value, SV is the investment starting value, and N is the number of investment periods. If we take R as the compound annual growth rate, then we have R is equal to ending value upon starting value, the whole raised to 1 by n minus 1 into 100. So this is the compound annual growth rate. This is the formula. So only one formula we have to remember. Apart from that, we have to remember the rate of return formula. Rate of return formula, it is ending value minus starting value upon starting value. A question on compound annual growth rate was asked in the sample paper for 3 marks. Suppose Ms. Suman invests rupees 25,000 in a financial plan, and after the completion of 5 years, she received a sum of rupees 32,500. Calculate compound annual growth rate. So here the starting value of investment is rupees 25,000 and the ending value of investment is rupees 1,000. The period for which investment was made is 5 years. We have to find the compound annual growth rate. So first let us write the formula. Compound annual growth rate equal to ending value upon starting value, the whole raised to 1 by n minus 1 into 100, where SV is the starting value of investment and EV is the ending value of investment. So given starting value was rupees 25,000 and ending value was rupees 32,500, and the period for which we have to find the growth rate is 5 years. So n is 5. So we have compound annual growth rate as 32,500 upon 25,000, the whole raised to 1 by 5 minus 1 into 100, substituting all the values in the formula. So this is equal to this. When we simplify, we get 1.3 the whole raised to 1 by 5 minus 1 into 100. In the question 1.3 the whole raised to 1 by 5, it is given, the value is given, it is 1.0539 minus 1 into 100. It is 0.0539 or it is 5.39%. So the compound annual growth rate of this investment is 5.39%. Now moving on to the next question. Similar question was asked in the sample paper for 3 marks. Mr. Abhishek has invested rupees 1 lakh in a financial plan whose compound annual growth rate is 9.5% and he received a final value of rupees 25 lakhs. Find the period completed for which he has invested the amount. So here the investment's starting value and ending value are given. Compound annual growth rate is given. We need the time period which is completed for which he has invested the amount. So here CAGR is given. We need to find n. So let us take, let n be the period completed. So we have compound annual growth rate is equal to ending value upon starting value, the whole raised to 1 by n minus 1 into 100, where SV is the starting value of investment and EV is the ending value of investment. Here the starting value was rupees 10 lakhs and the ending value was rupees 25 lakhs. Compound annual growth rate, it is 9.5%. So this implies 9.5 is equal to 25 lakhs upon 10 lakhs, the whole raised to 1 by n minus 1 into 100. Or from this we get 0.095, taking this 100 to the other side, and this when we simplify we get it as 2.5. 0.095 is equal to 2.5 the whole raised to 1 by n minus 1, or 1.095 equal to 2.5 the whole raised to 1 by n. When we take log on both sides, log 1.095 equal to 1 by n log 2.5. So from this we get n as log 2.5 upon log 1.095. So the values are given in the question that we can substitute here. So it is 0.3979 upon 0.0394. Now this, when we simplify, we get it as approximately equal to 10. Therefore, the time period for which the time period which is completed for which the investment is made, it is 10 years. So after 10 years, the value of 10 lakh becomes 25 lakhs if the compound annual growth rate is 9.5%. So here writing the formula carries 1 mark, then writing what is given, substituting the values, all these carries 1 mark, and then finding the log values and finding the value of n carries 1 mark. So a total of 3 marks. Now moving on to the next question. Mr. Ankit has invested rupees 6 lakhs in a financial plan, and after completion of 5 years, he received a sum of rupees 10 lakhs. Find the absolute return, simple annual growth rate, and compound annual growth rate. So here the starting investment is rupees 6 lakhs. After 5 years, that is the ending value is rupees 10 lakhs. We need to find the absolute return, the simple annual growth rate, and compound annual growth rate. So absolute return, first let us write what is given. Given starting value is rupees 6 lakhs. Ending value is rupees 10 lakhs. And n is 5 years. Absolute return, it is nothing but the current value minus cost of investment upon cost of investment, or it is ending value minus starting value upon starting value into 100. So it is 10 lakhs minus 6 lakhs upon 6 lakhs into 100. This is 4 lakhs upon 6 lakhs into 100. So this, when we simplify, we get it as 66.67%. So this is the absolute return. Then the second subdivision, we have to find the simple annual growth rate. The simple annual growth rate, it is nothing but it is the absolute return upon n. Absolute return is the total return in 5 years. So the simple annual growth rate is absolute return upon number of years. So it is 66.67 upon 5, which is 13.33%. This is the simple annual growth rate. And next we have compound annual growth rate. Compound annual growth rate, we know the formula. It is ending value upon starting value, the whole raised to 1 by n minus 1 into 100. So when we substitute all these, ending value is 10 lakhs, starting value is 6 lakhs, the whole raised to 1 by n is 5 minus 1 into 100. So this, when we simplify, we get it as 1.66, the whole raised to 1 by 5 minus 1 into 100. The value of 1.66, the whole raised to 1 by 5 is given as 1.1067. So it is 1.1067 minus 1 into 100, which is 0.1067 into 100. This is 10.67%. So this is the compound annual growth rate. Moving on to the next question. Calculate compound annual growth rate of unit sales on the basis of the given information. So for various years from 2012 to 2016, sales is given 53,000, 60,786 up to etc. 1,05,000 units of sales. So we need to find the compound annual growth rate of sales. We have compound annual growth rate as ending value upon starting value, the whole raised to 1 by n minus 1 into 100, where SV is the starting value, EV is the ending value of sales, and n is the time period. Now here we can, usually the sales data, it is collected at the end of the year. So it is collected at the end of 2012. It means beginning of 2013, the value was 53,000. So at the beginning of the year 2013, the starting value of sales is 53,000. And at the end of 2016, the sales data is 1,05,000. So here the number of years is 4. 1, 2, 3, 4. Starting value is 53,000. Ending value is 1,05,000. And n is 4. When we substitute all these, we will be able to find the compound annual growth rate. So it is equal to ending value 1,05,000 upon starting value 53,000, the whole raised to 1 by 4 minus 1 into 100. This is an example question which I have taken from the CBSE Handbook. Usually the values of raised to 1 by 4, it will be given in the question. So this, when we simplify, we get it as 1.9811, the whole raised to 1 by 4 minus 1 into 100. The value of 1.9811, the whole raised to 1 by 4, it is 1.18639. It is 1.18639 minus 1 into 100. So this is 0.18639 into 100, or it is 18.64%, nearest to 2 decimal points. So this is the compound annual growth rate. Moving on to the next topic, the last topic in financial mathematics, depreciation. Depreciation, it is the decrease in the value of assets such as building, machinery and equipment of all kinds. It is called depreciation. Now we will see some of the terms in depreciation. The first one is scrap value, residual value or salvage value. It is the value of a depreciable asset at the end of its useful life. Next we have total depreciation or varying value. It is the difference between the original cost and the scrap value. That is total depreciation. And next we have the book value. The difference between the original cost of the asset and accumulated depreciation at any given date is called the book value of that asset on that date. So these are the terms that we have to remember in depreciation. Next we have this method of depreciation, linear or straight line method of depreciation. So using this method, we can find the annual depreciation. Here, a percentage of original cost is written off every year. As a result, the amount of depreciation is uniform every year. So according to this method, the annual depreciation is given by D equal to C minus S upon N, where D is the annual depreciation, C is the original cost of the asset, S is the estimated scrap value or salvage value of the asset, N is the useful life of the asset in years. Here in this formula, C minus S represents total depreciation. And now we will see few questions on depreciation. On 1st April 2021, Rekha purchased an LED TV costing rupees 50,000 and spent rupees 5,000 on its erection. The estimated life of this TV is 5 years with a scrap value of rupees 3,000. Calculate depreciation using linear method with accounting year ending on 31st March 2022. So we need to find the depreciation for 1 year. On 1st April 2021, she has purchased the TV. We need to find the depreciation on 31st March 2022. So it is the annual depreciation that we have to find. The cost is given 50,000 and additional expenses are spent for installation, which is 5,000. The useful life of TV is 5 years and scrap value is 3,000. Using all this information, we can find the annual depreciation. It is given by C minus S by N. It is equal to cost plus erection charges minus scrap value upon expected useful life. So here the cost is 50,000 plus erection charges is 5,000 minus scrap value is 3,000 upon expected useful life is 5 years. So it is equal to 52,000 by 5, or it is 10,400. Therefore, annual depreciation D is equal to rupees 10,400. Moving on to the next question. A mainframe computer whose cost is rupees 6 lakhs will depreciate to a scrap value of rupees 60,000 in 5 years. Using linear method of depreciation, find the book value of the computer at the end of third year. So here the cost of the computer is rupees 6 lakhs. Given C is rupees 6 lakhs and scrap value is rupees 60,000. Its useful life is 5 years. The annual depreciation D, it is given by C minus S upon N. So it is 6 lakhs minus 60,000 upon N is 5. So it is 5,40,000 upon 5, or it is 1,08,000. Therefore, the annual depreciation D is rupees 1,08,000. Now we need to find the book value of the computer at the end of third year. Book value of the computer at any point of time, it is the difference between the original cost of the asset and the accumulated depreciation at that time. So we need to find the book value at the end of third year. So let us write the depreciation schedule. This is called a depreciation schedule, where we have year, annual depreciation, accumulated depreciation, and book value. So we have for year 0, 1, 2, 3, 4 and 5. Annual depreciation is the same. So at the beginning there is no depreciation. Then we have, it is constant, it is 1,08,000. For all the 5 years. Next we have the accumulated depreciation. The beginning of first year it is 0. Then at the end of first year we have 1,08,000. And then we have 1,08,000 plus 1,08,000, 2,16,000. Next we have 2,16,000 plus 1,08,000, 3,24,000. Then 3,24,000 plus 1,08,000. It is 4,32,000. Then 4,32,000 plus 1,08,000. It is 5,40,000. So this is the accumulated depreciation. Book value of the asset, in the beginning it is 6 lakhs, and then after 1 year it is the cost of the asset minus the accumulated depreciation. So at the end of 1 year it is 4,92,000. At the end of 2 years it is 6 lakh minus 2,16,000, which is 3,84,000. At the end of third year it is 6 lakhs minus 3,24,000. It is 2,76,000. At the end of fourth year it is 6 lakh minus 4,32,000. It is 1,08,000. And at the end of the fifth year it is 6 lakh minus 5,40,000, which is 60,000. So at the end of 5 years, the book value of the asset becomes equal to the scrap value if linear method of depreciation is used. Now we need to find the book value of the computer at the end of third year. So at the end of third year, the book value is 2,76,000. Therefore, book value at the end of third year, it is equal to rupees 2,76,000. So if the book value is asked, it is better to draw the depreciation schedule. It is better to draw a table like this with columns: year, annual depreciation, accumulated depreciation, and then we can find the book value by cost minus accumulated depreciation for each period. Moving on to the last question. An asset costing rupees 96,000 is expected to have a useful life of 6 years, has final annual depreciation of rupees 6,000 fixed. Find the final scrap value of the asset. So here the cost of the asset is given, useful life is given, and the depreciation is given. We need to find the scrap value. Yes. So here, or let us write given C is rupees 96,000. Annual depreciation D is rupees 6,000 and N is 6 years. And let us take, let scrap value equal to, yes, we have annual depreciation equal to D equal to C minus S by N. So from this we have 6,000 is equal to 96,000 minus S upon 6. So 36,000 equal to 96,000 minus S, or we have S as 96,000 minus 36,000, which is 60,000. Therefore, scrap value equal to rupees 60,000. With this, the revision on all topics in financial mathematics is completed. I hope this video was useful for you. If you have not subscribed to my channel, please subscribe. I wish all the students all the best for your exams. Thank you for watching.